Hey, thanks for being here. Before we get started today, I thought it could be important to mention the content of this video is for educational purposes only and should not be construed as investment advice, solicitation to purchase, sell, or participate in any trading strategies of securities in any way. I'm just some guy on the internet. Do your own research. You dummy. No, you're not. All right. Today I want to talk a little bit about valuing oil tanker companies. And I guess before I get deep in this, the reason I wanted to make this video is because I've noticed some other people talking about oil tanker companies and read some things about oil tanker companies that to me personally didn't make a lot of sense. Nothing against these people personally, and not to say that my way is the absolute best way to do it. There could be better ways, but I do think that at least sharing this idea on how I value oil tanker companies might be of some use to you and some other people. It's up to you guys if you agree or disagree, right? So one of the ways, before I even get deep into tankers, that I see other people valuing other companies is through a metric called PE. If you don't know what PE is price to earnings. One of the ways that PE might be calculated is through earnings through the previous 12 months divided by the numbers of shares in that company. Yeah. So, for example, Apple, if we were going to value it based on PE in 2007, for example, it had a PE of, 30 something, 38 at some points during the year. And you might argue, based on Apple's history and other tech stocks, that it was very expensive. And then you might also argue after the GFC, the global financial crisis, in about 2009, when it hit a PE of 10, that Apple was very cheap. You might also argue that again in 2012, 2016, etc. You may also notice, again, this is not financial advice, that you're noticing that we are above a PE of 30 in Apple, and that might be expensive. But nothing against you, Apple investors. Just, I guess, something to consider. All right. So PEs, however, do not make a lot of sense for tankers, and here are three reasons I think why. First of all, tanker earnings are very volatile. So you might see this is an exaggeration. These red lines over here at the top, but it's kind of to illustrate a point that their earnings go all over the place. So, for example, in Q2 of this year, tankers made inordinate amounts of money. They made insane earnings due to the contango situation, where there was a lot of floating storage on where tankers were being used as oil storage in the water. A lot of which was being hired by traders. They were trying to pay for oil and then sell it at a later date. Yeah. But you may also know that right now, for example, tanker earnings are in the pooper. They're terrible. There is an excessive amount of oil being stored that was generated earlier this year, especially during those lockdowns, and that now is being stored on land for the most part. And that has to be worked off before people start moving a lot of oil around again. Yeah. So oil tanker earnings, they're all over the place. And historically, you can look at that. There's all kinds of events that happen, right, that make those go all over the place. Second reason PE ratios are kind of sucky is that the tankers are also seasonal. So during the summertime, tankers don't make a lot of money. That's represented by the sun with the down-facing arrow. They generally do not make a lot of. That wasn't true this year, but during most years, this is true. The summer months, they tend to make not a lot of money. During the winter times, however, they tend to make more money. They may tend to have higher earnings. Yeah. So if we're thinking about this in terms of PE, it could get wonky when we're thinking about it, depending on where you start and end your trailing 12 months. Yeah. And tanker last, which I mentioned in my last video, which I would recommend that you go watch if you'd like to learn more about it, is that my last video, tanker earnings are cyclical, and which is one of the reasons why I'm very bullish long-term in this industry. They tend to go through long periods where they do not make a lot of money, and during shorter but relatively long periods where they make a ton of earnings. Yeah. So again, if you're going to be depending on where you're measuring it in this cycle, PE is going to be a relatively useless metric. So what I think is a better way to think about tankers, and I like to keep things simple. One of the best ways I can think about it is if you are buying a tanker company, not to think about it in terms of earnings, but to think about it in terms of the actual ships that these companies have, right? So imagine you're in your broker, you're clicking buy. Imagine that you are buying a portion of one of these tankers on the ocean, the physical tanker. So one of the metrics I think is important with that mindset is net asset value. So if you don't know, net asset value is the value of the assets. So for example, all the ships, maybe some of the buildings that some of these tanker companies may own, and you'd subtract all of the company's liabilities. So that might be all of the debts that these companies have. And believe me, some of these companies have some debt. Yeah. And you would divide those two things by the total shares outstanding. Yeah. Another way that I think is important to think about these companies is in terms of the age of their fleets. So NAV alone, it's useful, but it's not the only metric that I think is important. One of the questions when you're buying some of these companies might be to ask, how old are these ships? Yeah. So some tanker companies you may notice have newer fleets. And what this means to me is that these companies may need less ships over the short and medium term, right? If they have a lot of new ships, they don't need to replace these. If they're happy, if the company is happy with the amount of ships currently in their fleet, yeah. If they are an older fleet, then there's a lot of tanker companies also have some very old fleets. One way to think about these companies is that for this company to remain competitive, they are going to need new ships. If they have to scroll down a little to figure out how old their ship is, oh, whatever, they're in a less advantaged situation with this metric, right? So fleet age. And another reason why this fleet age is important, besides just the lifespan of a tanker, which by the way depends on product versus crude, but for crude it can be between 20 and 25 years, which is what this graph is talking about, right? So if you have a tanker that is approximately 5 years of age, which is on this graph, you might need to you will have to do a survey on the 5th year of that ship, which may cost about $1.5 million. And the reason why tanker companies have to do these kinds of surveys is because it's a highly regulated industry, perhaps for good reason. And if you think about it, these ships are transporting oil across vast distances in the ocean. They need to ensure that cargo can arrive safely. If there is an oil spill, that would be disastrous for both the company and the environment where that spill might happen. Yeah. So to hopefully prevent those things, the industry is highly regulated. And one of the ways they regulate that is kind of like through safety checks, like you might have on your vehicle for ships. So I mentioned they start at the 5th year, but you'll notice that over time, the costs of these surveys go up. So in the 10th year, the average price of a survey may cost $2 million. On the 15th year, that price goes up to $2.5 million. And then after a ship is 15 years of age, every 2.5 years after that, the ship needs a survey. And the price goes up over that. So not only are these older ships paying exponentially more amounts of money to get that survey done, they also need to do those surveys more often. Yeah. So if you have a company with tons and tons of old ships, it's going to be a lot harder for that company to be profitable based on these survey costs. And another way to think about this is that the older your ships are, the more risky they are as well. Okay, some other stuff that I think is important. One thing I'd like to mention, during downtrends, companies with excessive debt are very risky. So right now we have been and will likely continue to be in a downtrend for oil tanker earnings. What this means is these companies are more risky if they have a lot of debt. And the reason this debt is important is because they got to stay in business, yeah? And one of the ways that they're going to stay in business, well, they're either going to take on more debt, which kind of kicks the can down the road, but makes the can bigger, I guess, later down the line. And they may need to issue more stock. So one of the ways tanker companies have historically solved this problem, they issue more shares. What that does, it dilutes shareholders, and you notice that the share price will ultimately come down through events like that, yeah? And the worst case scenario is, well, the company is going to go bankrupt. And if you're an investor in a bankrupt oil tanker company, well, your return on investment is going to be negative 100%. And that's probably something that you're going to want to avoid. This man here, Mr. J. Mintzmyer, who, if you don't follow him, I would highly recommend. I read an article on Seeking Alpha, and I'll put the link to this in the description. Here he argues one of the best metrics for returns on a tanker company, which in return I think is an important value metric, are the dividends that these tanker companies provide. So in the past 6-month period, you'll notice at the top of this chart, one of the categories he's listed is a dividends basket. So these are oil tanker companies that paid high dividends based on their profit. They have, what would you call it, fluctuating dividends based on their profits. The companies that have the highest dividend policies tended to be the most stable share prices. So these dividend basket, as he calls them, Mr. Mintzmyer, not only were these companies paying you a lot of money to hold their shares, but those shares were some of the most stable. And remember, these companies, their earnings are very volatile, and so is their share prices. These companies that pay the highest dividends, their share prices tended to be more stable and more accretive in value. So I think that the dividend policies of these companies is also something to consider in terms of valuing the actual company based on what he's discovered.
Would you like to know more?
If you would like to know more, and you would perhaps like me to analyze some companies individually based on these metrics that I've discussed today, let me know below in the comments which tanker companies would you like me to analyze. Nordic American Tankers, DHT, Frontline, Sakos Navigation, Top Ships, Ardmore Shipping, TK Tankers, Euronav, International Seaways, DSSI, and Scorpio Tankers. I would be willing to, based on what you guys are interested in, review some of these companies based on the metrics that I've discussed today. If you found this information in this video useful, I would really appreciate a like, and also I'd like to hear from you guys in the comments, and subscribe, and I will based on your guys' feedback, continue making more videos like this. Thank you for being here.